welcome everyone to this afternoon's webinar. I'm going to be talking a little bit different than what Jarrett was talking about. He was looking at trades that might last a year or two. I'm going to be showing you some trades that might last a day or two. These are not necessarily day trades. Sometimes I set them up and go to the near-term month expiration. So I might be holding these trades for couple 3 weeks. Some of the trades come to fruition in a couple days, and if they are profitable, that's fantastic. A little different strategy. Purely technical. Purely technical. Now, what I'm going to be talking about today is trading the weekly successfully, and there's only 4 ETFs that I follow. And I do that because these ETFs give me a diverse portfolio. When the emerging markets, EEM, is up, GDX, the gold miners ETF, might be down. I want diversification, and these 4 give me great diversification. I don't want more than 4 because I can't focus on more than 4, to be quite honest with you. I can close my eyes and the charts look like for today on EEM, GDX, SPY, and TLT. They give me enough trades. I have plenty of stuff to do. I don't want to get any bigger than that, and I want to focus on a small market basket. Now, what do I look for? This is all technical. I'm looking, when it's a weekly trade, I've got to have something happen fast. I have to have an explosion. And that's what I'm looking for. I look at overbought, oversold. I look at the 5, 8, 13-day exponential moving average cross. I look at measured moves. And then when I'm in a trade, I look to exit using the Fibonacci extensions. I'm going to show you all that. Then I'm going to be talking to you about 2 actions that we happened just today. Then we're going to talk about catching the move no matter what the direction. And one of those is going to happen tomorrow, and I'm going to show you exactly how I'm going to set it up so that you can set it up. And if you don't want to put real money on it, I understand that, but at least maybe do it on paper, follow the trade, see what it's all about, see if you like it or not. If you do, then the unemployment report comes out this Friday at 8:30, or next Friday at 8:30. You might want to set up the same strangle position on that. Finish up with some trading tips, and then talk to you a little bit about what you want. Do you want to learn more? And I'm here to teach you more. If you went over all this in the beginning, but I'll just go over it quickly. The U.S. government required disclaimer: option trading has large potential rewards, but also large potential risks. You must be aware of the risks and willing to accept them in order to invest in the option market. Number 2, Options Infinity is not a brokerage firm. Our instructions for educational purposes only. This information is neither solicitation nor an offer to buy or sell. Please get the advice of a competent financial advisor. Past performances is no indication of future results. And then hypothetical trades are not subject to slippage and commission. Alrighty. Okay, let's go over the explosions due to overbought, oversold, 5, 8, 13-day exponential moving average cross, and the measured move. These lines here, and I use Thinkorswim as my trading platform. I'm not affiliated with Thinkorswim. I don't get a kickback from them. I just happen to, I trade my hedge fund through them, and I trade my very large portfolio through them. I think they've got the best trading platform as far as charts and commissions are concerned. So, you know, but I'm not here to tell you that's what you ought to do. It's a great one. What you see here on this chart, this is a chart of GDX, the gold miners ETF. The purple line is the regression line. The regression line is calculated by 50% of the price being above the line and 50% being below. So it's an excellent trend line. And the green lines are plus or minus 1 standard deviation, +1, -1 standard deviation. The gold is my gold standard. It's plus or minus 2 standard deviations. 95% of all prices will be contained within the plus or minus 2 standard deviation. It is a dynamite indicator to help you to determine when it's overbought and when it's oversold. Think of this as it's like the casing on a sausage, okay? Here you've got all the meat inside the sausage, and the old line is the casing. Occasionally you get a little bit that dribbles out, but not very often. It's a tremendous indicator to tell you when it is oversold. When it's oversold, you start looking for call opportunities. And then the same is true when it comes up here. When it's overbought, you start looking for put opportunities. This is just an example on GDX. And if you go from here to here, that's 354%. Now, I had about 10 trades on this move up, okay, that gave me more than that. But when I took the price from here to here, that was 354%. It kind of shows you the power of the regression channel. This is just the statistics, plus or minus 1, it gives you 68% of all prices, and then plus or minus 2 gives you 95% of all prices. Plus or minus 2, like I said, is my gold standard. That's what I watch. That's what I watch. Now, some stocks, some ETFs go plus or minus. Most of the ETFs that I follow stretch out, and they go all the way to the 2 and the plus 2, minus 2. Now, I've got a couple, one with on the SPY that just went all the way down to the minus 3. Well, minus 3 standard deviation is 99%. And you know that a couple weeks ago when the SPY was so low and everybody was wringing hands, I knew that an opportunity was awaiting me, and I was just waiting for a measured move. Here's the 5, 8, and 13-day exponential moving cross on the chart of the emerging markets, EEM. You'll see that the green is 5, the blue is 8, and the gold is 13. And you notice how a trade just doesn't go straight down and straight up. It kind of softened down. But the 5, 8, and 13-day cross holds pretty true. Here's a cross right here. Comes down. Yeah, we had a big pullback, but the 5 and the never crossed over, and it could have taken all the way down. Now, I like when it pulls back like this and doesn't go through the 13-day. I think of that as tramp. Think of the kids out in the backyard. They jump up, they jump down, they got 13-day exponential moving average, boom, up it pops. Or just the opposite when it's down. Now, why do I use the 5, 8, and 13? I love the Fibonacci number sequence and the Fibonacci extensions to help me exit a trade. The number sequence, you get that adding the last 2 numbers in the sequence. In other words, 1 plus 3. 2 plus 3 is 5, 3 plus 5 is 8, 8 is 13, okay? And I picked out for shorter term trading this number sequence 5, 8, and 13. Now I'm going to be talking to you about Fibonacci extensions in just a minute, or of them, but and that's why I love the ribbon with 8 and 13. A lot of people use the 5 and the 10 and the 25. Logic of using the Fibonacci number sequence. Now, you can see that here was a crossover, and it doesn't go straight up. It went straight up. This is a huge pullback. Boom, off it goes. That's a trampoline. Heads on up, back. Boom, off it goes. Heads on up, pulls back. Boom. that the price is going up, and then it pulls back, but C is a higher low than A was, okay? Then it comes up to this point and it makes high. This is a measured move, a bullish measured move. We want to trade with the trend. If we have bullish measured moves, we want to trade calls. Excuse me. Bearish measured move. It's just the opposite. We have lower lows and lower highs. Goes from A to B, back to C, which is a lower high. Okay. Then it comes down here and makes a lower low. Then this is where you want to get in. This is where you want to get in when it breaks through here. And then the next thing is where to go. And that's what I use the Fibonacci's to exit. It's just a chart of, again, of GDX, and you can see the measured move. You go from the high to the low, back up to the lower high, and then it busts through right here. You can see this is what happens. Then you get another measured move here, and this is what happens. Measured moves are showing you the short-term trend. I put them on a 1-hour chart. Sometimes I've got them on the 15-minute chart. Seems to give me enough information on the hourly chart to be able to trade weekly options. Now let's start talk about exiting using the Fibonacci ratios. Okay, we had just talked about the number sequence. Now, mathematicians have derived what they take the root Fibonacci ratio is any number divided by the last number. Linda, I'd be glad to. I'm going to be bringing up a chart here, and I will show you how to put on the regression lines. I mean, I can do it automatically. I used to calculate them by hand. Really got me to under them. I could see everything. I'll show you on Thinkorswim how to put those on. I don't other forms, but I'm sure if you contact your support people on those platforms, say I want to put on regression channels, they'll show you how. Okay, the root Fibonacci is 0.618. Now, what's interesting about the root Fibonacci ratio, it is seen throughout. If you look at how the petals grow a flower, they grow in proportion to the Fibonacci ratio. If you look at your bone, if you take the length of your forearm and divide it into the length of your hand, it will be very close to 0.618. It's uncanny. It's uncanny. Most of your major bones, 618. Now, doesn't it make sense that if the Fibonacci ratio, the golden root ratio, is seen throughout nature, that it would be applicable to the markets? Absolutely. Absolutely. Because what fuel markets? Fear and greed. What's fear and greed? It's human nature. Okay. So mathematicians have taken this root Fibonacci ratio and taken the square of it, square root, and it comes up with these numbers. People use those for retracements. I occasionally, but when I take the reciprocal of these, that gives you 1.7, 1.618, 2.618. That's what I use to determine where that level might be and where this trade might be taking me. Okay, and I'll show you how to put on the Fibonacci's too. Again, I'm going to be using Thinkorswim, and you can use, you know, you can contact your own trading platform support. But this is a chart of McDonald's I picked out at random. You can see here is the move down here, and here are the extensions. Notice the one to the 127. I know that it's either going to consolidate or pull back or reverse. Well, this one pulled back and then off it went to the 161. Then it kind of consolidates, pulls, boom, off it goes to the 261. It's uncanny how it follows this. I have gotten out of trades within one tick of the high. It's just amazing. And the more you do this, the more my mentees see this, the more a believer they are that the Fibonacci's are for real and they can reel your trading. I read a book one time where the author, he took a challenge and he said, I will show you a positive return on my trades independent of the entry. It doesn't matter what the entry is, and I'll use my strategies to exit the trade, and I will show you a profit. Indeed, he showed the trades, and it was amazing. The exit, I believe, the exit is more than the entry, and the Fibonacci's are where it's at. Okay, let me show you a couple trades. Let's put this together. On Friday, the SPY was, let's see, Friday would have been right here. The SPY made a measured move right here, okay? Then it went up during the day, and then it pulled back over the weekend, and then finally today it came up here and made a Fibonacci, and I will show you that. Let me bring over my Thinkorswim and see if can everybody see that okay? Everybody see my Thinker okay? Okay, great. Thanks, Jeff. Good deal. All right. Here was the level that I was looking at. You can see that it up here pulled back and made a measured move here, getting in towards the end of the day. This and now you say, well, when do you get out? When do you get out? Pulled back, came up. When I put on a Fibonacci, this was the 127. Okay. This also was a double bottom, so you can use a Fibonacci retracement. That was the one. And earlier, this move here gave a 261 right at this level. Right at this level. Did it make sense to get out towards the end of today? Absolutely. Absolutely. That was a trade that we got in Friday. We got out today. We got the 196 call at 134 and got out today at 290. That was 117%. Just by, first of all, I knew it was oversold. I'm looking for a call. I can see the ribbon is starting to cross. Indeed it did, right around here. The 5 and the 8 crossed over. Let me blow that up a little bit. Okay, I'm looking for a call. We had a measured move. One there, I got that one. One here. I mean, this here from the depths of where it was, everybody was wringing their hands, giving me 1, 2, 3, 4, 5, 6 trades. 6 trades. All based on the measured move, trading with the trend. How long do you stay in there? I like 27. I'm more a conservative trader, and I look to have my profit. I mean, hello, getting here out here at the 127 was 117%, and that's when you max your profit, because when you get out, when it's moving up, the premiums are higher. As soon as it starts pulling back a little bit, premiums, especially on the weekly options, evaporate very, very rapidly. Very rapid. Okay, Linda, to get put on the regression channel, Now this is Think or Swim. You go under Studies, you go under Edit Studies, and you scroll all the way down here on the left-hand side to Standard Deviation Channels. Standard Deviation Channel. Thinkorswim has it so that they update these automatically. You don't have to worry about it once you set up. And when you double-click on Standard Deviation Channels, do two of them, and one at a set one of the deviation of plus or minus. I set that at a width of 3, the gold standard, and then the other one was a plus or minus 1. I set that as green. If you want to, I put in 3 here, but you don't have to do that. I like the gold standard here. Once you have the up and you have them all synced, it just stays there, chart to chart to chart. You don't have to. Okay, let's just talk about the Fibonacci's, and let's actually let's go from the start here. All you have to do is click on Fibonacci, and if you start down here and bring it there, and then bring it down to a higher low, that starts the Fibonacci. Now there's the 127. You made the 127. That's the one I focus on, but you can look at the 160, 261 just by saying okay. That puts those in there. And when you're first starting out on a trade, it'll tend to hit that 127 and consolidate a little bit, push to the 161, and ultimately hit the 261. And that's exactly what happened here. And it's so very easy to put on the regression channel, to put on the 5 and 13-day exponential moving average line, and to put on Fibonacci's. I personally put these trend lines on just to make it slower and easier. But what you're doing is you're going from the low up here, pulling back, and once that, then you can put on the Fibonacci. But there's the measured move. When it crosses over here, it has made the move. Okay. Okay, looks like you're using 2 different time frames. Okay, yes, I do use 2 different time frames, Dan. I like for the term trades, I like to look at the 6-month daily chart on the left, and that kind of puts me in the ball game as far as what I'm looking for. I'm looking for a call, or am I looking for a put? And this tells me that, hey, the ribbon down here, this was puts all the way down, puts all the way down. Gets down here, it tells me I'm overextended, and I start looking for calls. Then on the right-hand side, I like to look at the hourly chart. Sometimes I'll go with a 15-minute chart to put on my measured moves and my Fibonacci's. Okay, I like the 5, 8, and 13-day exponential move line on a longer-term chart, and I like to keep focus on the term chart as far as the measured moves and the Fibonacci's. Okay, good question. Good question. Okay, here's one today. This was today. This was actually a triple measured move here. Came up, didn't quite penetrate through, had a back, came up here today. The first half hour of trading, you got into the EEM with a 41 call at 41 cents. If you close that out at the end of the day, that 41 cents is worth 68 cents. That's 40%. Yeah, that's all it is, 40%. 40% of the day, it's not bad. Am I still in this trade? Absolutely. Absolutely. What am I looking for? I'm looking for it to extend to the Fibonacci's. So I'm looking for another $1.50, no, less than a dollar, move EEM as it busted through this triple measured move. Now, look at what we have on the longer term chart. It was oversold. And look at how the ribbon is just about ready to cross over. This is a call opportunity. This is a call confirmation. This is a wonderful time to get in today. We made 40% in a day, but I'm still in it. Steve says, looks like this strategy should be applicable to Forex. It's applicable to anything. It's applicable to anything. And I trade stocks. I trade options. Same kind of strategy. I love the weeklies because they're a little faster, they keep toes, and they make it so that all my brain cells are clicking, I guess. And it's great practice. It's great practice. You scale out as you go. I do not, Simon. I'm either all in or all out. I'm all in. I'm all out. Okay? Now, if we go back to the SPY, this is an all in, all out. Wait. All in, all out. Wait. Okay? So you might have a number of trades going at the same time, but one measured move, either all in or all out when it gets to the 127. But I might have 2 or 3 trades going on at once. Okay. So let's catch the move no matter which direction, and that's using Strangles and Straddles, and this is these on events. When an event comes up, what I'm looking for is something like the FOMC is meet today, and they'll be finishing their meetings tomorrow around noon, and at 2 o'clock they'll make their announcement as far as any changes in strategy. Well, I don't know what direction it's going to go. I really don't. I don't know what the FOMC is talking about. What I'm looking for is a big change tomorrow, either one direction or the other. Therefore, what I'm looking to do is put on a strangle. So I'm looking to buy a call and a put. A call and a put. So I have both directions. Okay. Then I'm looking for a quick move in one direction or another. Now, yes, you've got to cover the cost one side, but most of the times you get a big move in one direction or the other. This is just an example of a big move. And let me just say, I'm showing you some very nice today. They're not all like that. This strategy is about a little bit better than 50-50. As a professional trader, you need to embrace losses. Losses is trading, and that's why you always have to have risk management. I always put on about 1% of my on any trade. Okay? Remember that as you go forward. It's not all. I'm showing you some really nice stuff here today, but sometimes it doesn't work out. Okay? And I get out anywhere around 20-50%. Okay? But the thing is, with 15, if you get out 25% on the losing side and you average 75 to 100 winning side, that is a positive expectation, and what you do then is do it over and over and over and over again. All right? Here's the unemployment report. This was last November. The unemployment report comes out the first Friday of the month. It comes out at 8:30 before the market opens. If you want to watch the talking heads talk about the NBC, I tune into the talking heads early in the morning, although I don't listen to them. See what happened in the markets overnight, and I like to see things like reports that are coming out. The report came out at 8:30, and look what happened to TLT. We set up the strangle the night before at 109, and before the market even opened, it was at 104. That's a huge drop. That's a huge drop. Well, what kind of profit could you get in that? Set that strangle at the 106.5 call and the 105.5 put, because this is where we were. 105.9 was the 106. Contract, $42 a contract, buy what you want, okay? And the next day he exited the next day, and that $4 had gone to 207. Yeah, the call went worthless. The put guy. $42 times 50 is $2,000 investment. $2,000 investment brought in $10,000, 350 in a day. They all work that way. But you don't need too many of these guys to counterbalance a loser. So let's talk about, well, let me just say that if you're interested in this, there's three things that I look for, and if you were listening to Jarrett's discussion before the minute, the Fed in the U.S. is looking at two things really, and that is the non-farm payroll, the unemployment situation. That's the first Friday of the month. It's also looking at housing starts. Markets economic calendar and get care for when these happen. My calendar has them. Next year's updating my calendar. I know exactly when that information is coming out. Okay, so let's set it up for set it up. Let me get my monitor here. Let's set it up FOMC tomorrow. And what I like there is the FAS. The FAS is a bullish indicator. And you'll see that if you compare the FAS to the RUT and the Dow and the SPY, it's a little bit more of a bullish move here. It's had moves on the way up. But with that kind of a move, this move has occurred in less than 2 weeks. That is a very bullish move. Now, if the FOMC comes out tomorrow and says, well, the economy's slowing down a little bit, we're not seeing that, that is bearish, and those words will cause this to tank. Okay, or the FOMC could come out and say, you know something, the economic data confirming the unemployment report from October, we are confirming that the economy is now indeed really going to town, and you'll see a big move up, and that's what you like to see. That's what you like to see. Okay, how are we going to set this up? All right. The report will come out and be released at 2 o'clock tomorrow. 2 o'clock tomorrow. So, and you'll see not much happening as the market approaches 2 o'clock. And as soon as the market says what the FOMC is doing, you will see the market react. Here again, you can watch this in CNBC and see it live. What you want to quick in one direction or the other. If you see the market yawning, get out. What are we going to set up? Let's go into the trade tab. You're going to look at the option chain for the current month, or go to at least give it more time here. Yeah, David, either the TLT or the FAS. The TLT can set up a strangle a little bit cheaper, but if you're putting the same amount on the trade, it's okay. One reason that I'm leaning towards putting on the FAS tomorrow is because the TLT, I currently have it in that. So I already have a short position on D, so I would have to balance it, and it would be too expensive. That's why I'm thinking about the FAS tomorrow. No, I don't look at the deltas, Alan, for my strangles. Basically, what I'm looking for is I come down here, and tomorrow what you want to do about 10 o'clock, wait till this kind of settles down, anywhere from 10 to 12, what you want to do is here and see what the last price is. That's the at the money price. If it's 1.5, okay, this is the at the money, that would be a straddle here. What I like to do is I go out at least one, if not two, strike price away. Okay. Now, you'll notice that today, let me go back to the chart real quick. This move here was it went from 103.4 to 103. That was a $3 move in a day. Okay. Here, if I strangle, that's maybe to the, if it's at 106.5, maybe to 107.5, and then what I want to do is balance it out. So that's $1.13. I look over here for a put side. $1.13 is a 105, and that's what I would do. That's what I would set up. 105 call, buy it. 105.5 put, buy it. You can easily set this up. All you have to do is just click on either one of them. You can right click. What you want to do is and you're going to sell a strangle. And there it is. Now, you're going to have to then move this around. 105.5, the call should be the 107.5, and that's how much you're going to pay. Now, I always go in at the midpoint. There's a pretty good bid-ask spread, so you want to go in at the midpoint and give it some time to fill. Give it some time to fill. And remember, you're selling this. Excuse me. You're not selling it. You're buying it. I hit the wrong one. You want to buy a strangle. Yeah. Thanks. Yep. You want to buy it. Okay. Let's see. So that's what we're looking at. Set it up on paper. I mean, set it up right now. Let's say you buy the 107.5 call, and you're going with the fifth week of October, which has 3 days left. You're going with the 107.5 call, and the midpoint on that is the mark on the $1.13. All right, and then you want to blend that in, and we're gonna buy the 105 put. That's $1.13. So you're going to set up your trade. You've got the 107.5 and 05, and that's going to cost you about $1.30, $2.30. Okay. Now just wait. See what happens tomorrow. Watch the excitement. See if you like it. If it doesn't move, remember you got to get out quickly because that premium is going to evaporate. Okay, don't stick around if you don't see much movement. But if you see some activity, you might want to hang in there. Now, what are you looking for? Fibonacci's. Fibonacci's. Ron's question is, says, does Thinkorswim include a real-time data feed to monitor the options and change down minutes? They on the actual platform, they show their charts and their watch list are tick by tick. They're tick by tick. Okay. Okay, sure, Roxy. I'll go over that again. Absolutely. Let's say we want to buy the 107.5 call and the 105.5 put. So you can either click here or you can click here. You click here. You want to buy Strangle. Now so we got the call and we want to come down here and reset put. 105.5, $2.30, and then you want to adjust your quantity accordingly. Always go at the midpoint, confirm and send. Okay, Roxy? Okay, excellent. Now, then the following Friday, if you like this, you know, set up a straw unemployment report. You know what's interesting is the last 4 months, the unemployment reports kind of markets kind of, and last month I didn't do it, and it exploded. It's like, well, that just makes sense. Okay, I like the FAS. I like the TLT, and I like the for the events. I've got trades in the SPY and TLT, so I'm probably going to go with the FAS. Now, if I have a trade on either the TLT, I'll go with those going into unemployment. Yes, this is weekly options. These are weekly options. When you come over to the option, no matter what your trading platform is, it will show on these ETFs. They all have weekly options, absolutely. Okay, and it'll be either October the 5th week, November the 1st week, November the week. The regular expiration, November 4th. Okay, these are all weeklies, and you get more weeklies as the time goes on. You're welcome. You're welcome. Okay. I always like to talk about trading tips because it's important to know why people lose. This is not an easy way to make money. But you can make money if you treat this like a business. Right? It's going to take you time. It's going to take effort. You're not going to end this seminar today and be a millionaire tomorrow. It's just not going to happen. First thing you want to do is don't overtrade. A lot of people look at charts and, wow, that looks pretty easy. I can do that. I can do that. And out with $1,000, $2,000 account, and they put it all on the first and they go, ugh, that didn't work, and they never come back. Start small. Don't overtrade. My rule of thumb is if you feel any anxiety while trade is on, then you have too much at risk. Have a trade on, and that's all you're dreaming about, and you don't get any sleep, and you wake up the morning and you find out it went against you, you're going to close it out, and you're going to close it out fast, and you're never going to talk. If If you feel any anxiety while trading, you have too much at risk. Like a baby, I never have a large percent of my portfolio on any trade. Okay? Remember, these trades usually start out losing, and you're going to have some losing streaks, and those losing streaks, you've got one. If you have a robust strategy, if you have one that's a little bit better than 50-50, and that when it loses 25 to 50%, and when it wins, it wins 75 to 100, that is a positive expectation. It's just a matter of doing it and executing well. This is into the webinar, B. It started at about 6:30. These are being recorded, and I think everybody who has attended this will get the recorder. Okay, the second thing is don't be too quick to take profit. I like the Fibonacci's. It's like, you know, you want to cut your losses short and profits run. Well, how long do you let your profits run? And that's why I love the Fibonacci. I'll tell you how long it should be. If the direction's obvious, take it. If it's put on this, follow the rules. Follow the rules. Can't say enough about this. Start small. Paper trade. If you can't make money, paper trade, think you're going to do once you have real money on the line. Take time to go learning curve. Take time to go up your learning curve. Okay. Okay, on your standard call and put trades, do you use a trailing stop or just move, take even? What I usually do, Simon, is I usually trade a mental stop. I know where it makes sense to get out. I'm looking at some distance. A lot of times when I'm trading the short-term weeklies, I will put in a stop, a hard stop, but I don't like too many hard stops. I'd rather have a mental stop and follow that accordingly. Okay. When it gets close to a profit, I can either put in a profit stop, or I can wait till it hits that point, know what that point is, and as soon as it does, I'm out. Now, I don't advocate watching your charts all day long. I personally don't do that. I watch the market. I do all my research in the morning. I'm ready to go rock and roll at 9:30. I watch it till about 10:30. Then I touch base again at noon, and then I come back and watch the close from 3 to 4. And that's enough to be a success. I don't watch tick by tick. That's enough to drive you crazy. Okay. Question about teaching, and that's interesting because that leads me right into the next slide, and that's so you want to learn more. I do teach. I'm not only a professional, I do this for a living, I trade for a living, I am successful, I make money. I am not one of those teachers that teachers do. I'm a doer, and now I'm a teacher. I've made my money. Now I'm giving back. Okay, and my son and I, my son graduated from Penn State, and on these he put together our website, www.brethaueroptionmentoring.com. I know that's a mouthful, but once you have it in as a favorite, it's fine. BRETHAUER and mentoring.com. There's two things. One is you can look at workshops that I've done, and they're for pay. They basically say my different trading strategies. Today I'm talking about this. This is an in-depth shop. But the thing that's most important, I think, is the website. One, you get a crash course on all my strategies. Two, you get a nightly video blog. It's kind of like looking over my shoulder. I'm showing you what I'm doing, how I'm managing a trade. And three, you get a twice-a-week mentorship webinar lasts for an hour, 6 o'clock till 1 o'clock every Tuesday and Thursday. It's recorded if you can't get in there, okay? And all that is included in the website. In the website, $49 to get started. Here it is, www.Brethauer Option Mentoring. Talk about the market basket, right? Okay. You get the trading videos and the live mentoring session. There's plenty of time to ask questions in the live mentoring session. One of the things I like about the live mentoring session is a lot of people actually bring stocks into the room and we discuss them. One of the men got in Citrix just recently, and we all got a put on Citrix. And for a small investment, you got a very nice profit on Citrix that more than paid for a number of months. And that's the way it ought to be. You learn as you go, and you make money as you go, and that's what this website is all about. You can just come down here, here's the members area. You got the blogs and the mentorship webinars. If you miss those, you just come in and review those. Here's all the workshops and so forth. This is a website that will teach you how to be a success. We talk a lot about the psychology of trading too. Okay. Let's see. I had a couple questions come in while I was busy with. Okay, learned a lot. Ready for more? I'm ready for you. Dale, I'm a newbie. I've never traded options before. How should I start? Small. and I think the way to do it is to start a small account, but paper trade for a while. On web, I've got some lessons that talk about what is an option, what is a put, what's a call. It's the basics. It's option basic. You know, I had a friend who is a tremendous golfer, and he's never shot 80. And he says the reason why I've never shot 80 is when I first started playing golf, I took a year worth of lessons. I learned from a pro, and I practiced, and then I was ready. He's a tremendous golfer. And that's the way I think a brand newbie ought to do it. Start small, learn from a professional, and take the time to learn it well. Do you manage other people's portfolio, Olga? The hedge fund is closed, and I do not do that in. $49 is for the first 30. Is correct. If you like it, it goes up from there, and the website will tell you what that is. Okay. What platform should you have? I like Thinkorswim. A lot of people have Options Express. Options Express is fine. They have just about everything you need on there. I know some. Let's see, what's the one that they use? It's a little bit harder to navigate. Can't think of it right now. You know, I'm not an advocate for any one of those. It's kind of a personal choice. Personal choice. TradeStation is one of them. Yes. Does the Financially Strong course cover covered calls? I do not do covered calls. I do not do covered calls. If I invest in a stock, I don't want to cap the earnings on that by doing covered calls. I think covered calls is a not real solid strategy. Interactive brokers is another one. Yep, Trade Monster is another one. Okay, and these will Trade Navigators, another one. Yep. These all will vary as far as their commissions and everything else. You have to make you'll have to make your own choice on that. Okay. Yes, yes. A newbie should probably call and puts it first. Yes, I think that's a good idea. I think I've answered all the questions.